Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, May 2nd, 2024. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is Jay still wants a soft landing, but for how long? So the nuance there is that yesterday's FOMC statement and Powell presser were both surprisingly dovish. Specifically, the Fed tapered its balance sheet runoff policy from 60 billion treasuries per month to only 25 billion, and Powell downplayed both the recent backup in reported inflation and the likelihood of further rate hikes. In terms of market implications, even though Powell continued to talk up supply-side healing in his presser, the latest key supply-side data are damning to his Pollyannish take regarding the outlook for inflation. Incrementally adverse outcomes in supply-side data will make it increasingly difficult for Powell to continue turning the other cheek with respect to above-trend annualized inflation readings. The Fed and Treasury Department are now engaged in what should feel like good cop, bad cop policy to market participants. And just in case you missed it, I joined my friends, our friends at Real Vision yesterday afternoon for the Real Vision Daily Briefing, where we unpacked this week's diametric FOMC and quarter funding announcement catalyst. So definitely make time to check that out. So as always, we'll wrap up with a question from our community in our 42 Macro client dashboard here. This one's regarding QT and liquidity, reading, how does the drop in QT impact the liquidity environment? Is it enough to offset the hawkish QRA? So I'll do that in reverse. No, it is not enough to offset the hawkish QRA. Recall that the Treasury Department is planning to issue $1.1 trillion in coupons between Q2 and Q3. So that's something to be very much aware of. And then with respect to so $1.1 trillion in coupons versus $25 billion a month in balance sheet roll off is certainly not going to be enough to offset that. In terms of the drop in QT impacting liquidity environment, so in our view, the Fed, and we've been maintaining this view really for 2 years now, the Fed is not doing QT. The Fed is not selling assets into the open market in the same way that it buys assets when it's performing quantitative easing. The Fed is performing balance sheet runoff, which at the margins is a more liquidity positive balance sheet policy tool. And in our opinion, they got more liquidity positive at the margins by reducing the runoff rate of 65 billion to 25 billion a month. And so what that effectively means is that, as the Fed every day, so every day, week, month, the Fed has Treasury securities that are maturing in portfolio. And, in terms of, and the Fed, in order to maintain the same size of balance sheet, the Fed takes those proceeds from the principal payments of those maturing Treasury securities and buys Treasury securities to the market. So they're constantly doing that, because bonds roll down the curve in terms of the maturity in order to maintain a similar size balance sheet. However, when they do balance sheet runoff, they say, hey, so for 60 billion of that, that those proceeds this month, we're not going to reinvest. We're actually just going to allow, bank reserves to decline in that regard, and they're shrinking that 60 billion to 25 billion. So it's positive at the margins, and we continue to see this Jay Powell-led Fed is one that is A, kowtowing to fiscal dominance, and B, very much dovish and wanting to enact a soft landing in the economy. However, as we talked about, in our lead-off morning note today, it may be the case that the supply-side data in the economy and incremental adverse inflation prints force him from being able to do anything about, a tightening of liquidity conditions vis-a-vis a stronger dollar, vis-a-vis more fixed income and currency market volatility. So those things are ahead of us. If you want some specific guidance on how to risk manage this in portfolio terms, obviously you need to be a client of 42 Macro. So we'll wrap it up there. Everyone have a wonderful day. Best of luck out there. Catch you back here tomorrow. Cheers.